American companies face a tax penalty when they compete for market share around the world. But this penalty is not imposed by protectionist foreign governments. Instead, this discriminatory tax is levied by American politicians. You're probably thinking that this can't possibly be true, but it is. Even more amazing, President Obama actually wants to make the penalty even more severe, although that will further tilt the playing field in favor of companies from other nations. I'm Dan Mitchell of the Cato Institute, and this Center for Freedom and Prosperity video is going to describe how seemingly obscure tax policies can have a big impact on American jobs and American competitiveness. First, some background. The United States is one of the few nations in the world to impose worldwide taxation. This means that American firms are taxed not only on the income they earn in the United States, but also on income they earn in other countries. This policy of worldwide taxation is rather unfriendly. Indeed, this is one of the many reasons why all good tax reform plans, such as the flat tax and national sales tax, eliminate worldwide taxation and instead use territorial taxation, which is the common sense notion of only taxing income earned inside national borders. But let's set aside the principled argument and focus on the day-to-day challenges caused by our current system of worldwide taxation. The first problem is that any money earned abroad by American companies already is subject to all applicable taxes in those other nations. That's not too surprising. After all, the IRS taxes foreign companies that earn money in America. But if two countries tax the same income, that is an unambiguous form of double taxation. And even the politicians in Washington realize that two layers of tax would cripple American companies trying to compete around the world. As such, U.S. firms with foreign income are allowed a credit for corporate income taxes paid to foreign governments. That's certainly better than nothing, but now we come to the second problem, and it's a big one. The United States has a 35% federal corporate tax rate, which is very high compared to other nations. Indeed, if you count state corporate tax rates, the U.S. has the world's second most punitive corporate tax regime. This high corporate tax rate, combined with worldwide taxation, is a huge liability for American companies. To see why, let's look at an example. Let's say an American company is competing around the world against a Dutch company. Both companies have manufacturing divisions in Ireland, servicing divisions in Hong Kong, and financing divisions in the Cayman Islands. And to keep our example simple, let's assume each division generates $100 million of profit. Now let's add taxes to the equation. The Irish government imposes a 12.5% corporate tax on both companies. The Hong Kong government imposes a 16.5% tax on both companies. And the Cayman government imposes zero tax on both companies. So far, so good. But we need to remember that the U.S. has a worldwide tax system and the Netherlands has a territorial tax system. This means that the American company owes tax to the IRS on the $300 million earned in the three jurisdictions. But the Dutch company does not need to pay any additional tax on its $300 million. And even if the American company is allowed full credit for taxes paid to the three foreign governments, its total tax bill will be more than $100 million, more than 3 times higher than the tax bill for its Dutch competitor. In a competitive global economy, this is a giant disadvantage for an American firm. And this is why politicians, in an unusual display of common sense, created a policy known as deferral, which allows American companies, in at least some circumstances, to delay the extra tax. U.S. businesses still don't get to compete on a level playing field, but deferral does significantly reduce the self-imposed tax discrimination caused by America's worldwide tax system. Returning to our example, maybe the American company would get to postpone $60 million of the tax, so it would only have to pay $45 million this year compared to $29 million for its Dutch rival. That's bad, but not nearly as bad as worldwide taxation without deferral. Let's now talk about possible ways of making America's tax system better. Some of you are probably thinking that a lower corporate tax rate would help. Others are probably thinking that America should move to a territorial tax system. Both reforms clearly would be big steps in the right direction. In the strange world of Washington, however, moving in the right direction does not seem to be an option. President Obama and his allies on Capitol Hill actually want to make America's tax system even less competitive by restricting deferral. I'm not joking. It's in the president's budget. And he held a big press announcement to talk about the plan. And you're probably asking yourself, why would Obama want to hamstring American companies in the global marketplace? There are two possible explanations. First, politicians love tax revenue. It's like crack for them. And the president's budget claims that the international portions of his tax plan will collect as much as $210 billion. In reality, it won't collect anywhere near that much because of Laffer curve effects, but that's no obstacle to politicians. They'll just assume the money will materialize, and that allows them to further increase the burden of government spending. The second explanation is that some people in Washington think deferral is a subsidy to move jobs offshore. They argue that if an American firm can earn money in Ireland and only pay a 12.5% tax, this gives them an incentive to close down factories in America and ship them overseas. Since nearly 90% of what American companies produce overseas is sold overseas according to Commerce Department data, there's not much evidence that this is actually happening, but there is some truth to the argument. If a company can save money by building widgets in Ireland and selling them to the U.S. market, then we shouldn't be surprised that some of them will consider that option. So does this mean the president's proposal might save some jobs in America? Definitely not. If deferral is curtailed, that may prevent an American company from taking advantage of a profitable opportunity to build a factory in some place like Ireland, but U.S. tax law does not constrain foreign companies operating in foreign countries, so there would be nothing to prevent a Dutch company from taking advantage of that profitable Irish opportunity. And since a foreign-based company can ship goods into the U.S. market under the same rules as a U.S. company's foreign subsidiary, worldwide taxation does not insulate America from overseas competition. It simply means that foreign companies get the business and earn the profits. Let's wrap this up. If deferral is curtailed or eliminated, several bad things will happen. American-based companies will become less competitive since they will face higher tax rates. Those U.S. companies also will lose market share around the world since foreign companies will have a bigger tax advantage, allowing them to charge lower prices. America will have fewer exports, since a big chunk of our overseas sales today are the goods that American firms sell to their foreign subsidiaries. And American workers will have fewer jobs because of the reduction in exports. Sadly, politicians either don't understand or just don't care. All that matters to them is that they get more money to spend. But maybe things will change if enough people know the truth. Please help the Center for Freedom and Prosperity and share this video widely. I'm Dan Mitchell. Thanks for giving me some of your time.